Greetings, investors. Welcome to Investor's Edge. My name is Gene Melamud, and I'm here with my esteemed colleague,
Hunter Burnett.
Today, we're going to talk to you about change. Life changes. They generally cause a lot of stress, anxiety, and the change and the way people deal with this that we see most often is preparing for retirement and getting into retirement. This kind of change causes a change in your routine, right? How are you going to get up in the morning? What are you going to do? Where will the paycheck come from? How will you stay busy during the day? What's the risk of, God forbid, your money dying before you? And what is your family? What are your loved ones going to do? What if you get sick? And so you have all this time to think about things that causes anxiety. So today we're going to give you a taste of what is it that we do, the steps that we take to take your anxiety down, to help you figure out whether you're in fact prepared for your retirement. I think you're so great at this, Hunter, and I think you should really take the wheel and really walk our audience through what is it that we do for budgeting, for goal planning, so that they feel comfortable making this big leap.
Perfect. Thank you, Gene. Well, today we're going to get started talking about adjusting your financial plan when major life changes happen. We're going to do that through a presentation of a goal plan and monitoring. We'll get to the monitoring portion of that later. However, it's essentially we're going to work on a retirement plan. Today's case, we'll be discussing Clark Kent and Lois Lane. It's a hypothetical situation.
I like those names.
They're great names, right?
Yeah.
Some might say they're super.
Yeah.
And they are hypothetical folks, do not exist, so we're just going to look at their scenarios and just take the example from there. Before we get started on Lois and Clark's goal plan, I want to just discuss a few disclosures. The projected returns that you'll see through for the investments are based on the average annual return on those asset classes. They're just projections, they're not factual, they're not based on something that we believe is going to happen. They're completely based on average annual returns. And they go across many different asset classes, as you can see here, from cash all the way down to alternative strategies. Moving forward, we just want you to understand that this uses an average return, a result of many different scenarios that have been projected. 1,000+ scenarios where we take an average of all of them to present a return or a success of your funds lasting throughout retirement to accomplish all the goals that you may have. And then lastly, just wanted to point out that there is risk associated with investing at any point in time, and that is something that we've tried to capture through the average of these returns with the bad time, stress market, great financial crisis, so on and so forth. All right, taking a look at Lois and Clark. This is their information they've provided to us, as well as the goals they'd like to achieve. With that information, we go ahead and put it in that Lois is looking to retire at age 65 in 2025. We see that Clark's already retired and they have about $37,000 of expenses that they'll need to take from their portfolio to pay for it now that Clark's retired. Moving forward, we can see as they're both retired, they need to withdraw a little bit more from their retirement accounts. And then when Clark passes away, Lois will be alone for a few years and will have a little bit of expense herself. We have a baked-in inflation rate of 2.2%. Moving forward, we can see Medicare. They'll both be eligible for that beginning next year. Our system uses an average estimate of historical prices for Medicare to come to this amount. There's a remaining car payment of about $6,000 happening for the next 3 years, and that's per year. Their mortgage in Smallville, Lois and Clark's home, is roughly about $32,000 a year, and that's occurring for the next 6 years, as we can see. So as you can imagine, all these inputs vary across each different client. In this case, Lois and Clark have a few different debt payments as they're going into retirement. And we can also see that Clark has a long-term care policy that he's paying about a $1,200 premium for. He's worried that something may happen to him and wants to ensure he has coverage. Lois and Clark would love to purchase a vacation home when they retire, and about $250,000 what they budgeted for that. That's a major life change. That is a large investment, that is something that will be discussed no matter what the scenario comes back as being. Travel, they also love to travel, spend a few $1,000s on that every year. They plan on doing that until they're both about age 80. Their daughter, Cara, is getting married in a few years, and they can expect to spend $20,000 or $80,000 for her wedding. Not on her wedding, because they want their baby girl to be happy. Here we see Lois is making $60,000 with some personal information, and that their 2 children are both non-dependents. As we can see here on this page, Lois and Clark both have a retirement account in addition to a joint brokerage account. Also, we can see the value of their home is worth $700,000, and we do not expect to sell that home to pay for any of their goals throughout retirement. Moving on, as we mentioned, we could see Clark's long-term care is just covering home care only. It's not providing nursing care. It's just home care, and that's all. Clark has recently filed for Social Security, and he's projected to receive about $40,000 a year, whereas Lois is going to wait until her full retirement age of 67. And she expects to receive about $31,000 a year. Now, Gene, would you mind explaining briefly just what the difference between the Social Security ages may be for people who delay filing?
So some folks say, listen, I'm a short-lived individual. My family tree is such that I don't live long. And besides, some folks say, well, we don't have confidence in the government. What if they run out of money? And they're talking about taking Social Security as early as 62. Well, keep in mind, every year that you wait, every year that you don't take Social Security, you get an increase, an adjustment of about 8% or so, increase in pay. So you get paid for waiting. And if you take Social Security before your full retirement age, which is right around 67 years old, let's say you took it at 62, if your income is above a certain threshold, your entitlement can actually be reduced. So if you wait until your full retirement age, at least 67, then you could have side jobs that will not reduce your Social Security. Ideally, from all the numbers that we have done, you ought to wait until you're 70 and collect at 70. But for the purposes of this illustration, we're assuming that you're going to take Social Security at 67. You get paid for waiting.
Sounds like a great deal to me. Thank you for that, Gene. Moving on, we can see that Lois has a pension that she's receiving from the Daily Planet, her employer at the end of this year when she retires. Lastly, we see that they have a remaining mortgage on their Smallville home of $200,000, and that's about 4.2% interest rate with a $2,700 monthly payment. This next page is what we do. We just compile all of your assets and liabilities and just put it in a quick little bar chart, just easy to see the difference in what you have as well as your investment accounts. Moving on, we see the current portfolio allocation of how the assets they have invested in their retirement accounts as well as the joint brokerage account are handled. If you're heading into retirement, which they are currently seated at about 80% stock, which means they are in 4/5 of their portfolio is more risky. About a fifth of it is in assets designed to protect your principal and provide a steady stream of income. That may be something we want to look at suggesting a change based on their risk assessment. Risk assessment is something that they have filled out ahead of time through a little questionnaire, and combining the two, we can see they have a risk score of 52 out of 100. That correlates more so towards a balanced strategy, and that's something that we would communicate to Lois and Clark to be, hey, you may want to reduce your exposure to these risky assets and dial it back just a little bit. Because we can see what would happen if this portfolio had been invested during the Great Financial Crisis, 2007, 2009, that they would have stood to loss about a third of their portfolio.
One more thing, just it's real key to remember, your income, your demand for cash flow doesn't change just because the market is down. So if the market is down 27% as it was during the Great Recession, your portfolio continues to make distribution. This 27% is not a number that we made up. This is a number that this smart software goes back and takes this allocation and does, through Monte Carlo analysis, goes back decades to come up with an approximate performance of this combination of investments to what would your loss be in that year. So when we talk about risk, we use this information to see, would you feel comfortable with these kinds of declines, knowing that the underlying investments have to provide the income that you need to move through your retirement?
Perfect. Thank you, Gene. It's a great stress test. A more recent one in history would be 2022 as well, in which we could take the performance of the market, and that may be more recent for folks entering retirement soon. All right, now after taking all those inputs, we can see the results clearly here. Based on the inputs Lois and Clark provided to us, their chance of their funds lasting throughout retirement and paying and achieving for all the goals that they have is about a 62% chance of success. What we do from there is we take a few different inputs to provide a recommended scenario. These are changes that you may or may not make, but we show changes that may help improve the chance of your funds lasting throughout retirement and paying for all those goals. Ideally, more than ideally, we want above a 75% threshold. Moving on, we can see that we were able to change that amount from a 62% chance of success to an 86% chance of success with just these simple changes. Instead of purchasing a vacation home for $250,000 or even financing it and taking on new debt as you enter retirement, which I would not have advised in this situation unless they really pushed it, what we instead suggested is maybe travel and spend $25,000 a year. Treat yourself. Go to the Ritz-Carlton. Go to the JW Marriott. Enjoy that, and that may be something they are receptive to or not, but that's a discussion that we'll have to improve their chance of their retirement success. Lastly, maybe Cara doesn't need the lobster for her wedding, and maybe we could save $10,000 for that and also improve the plan. All that happened was we decreased spending by about 1% over the life of the plan, and we improved the success of the retirement plan lasting throughout the remainder of your lives by 24%. Lastly, the one other thing that we changed is we wanted to show, as Gene was mentioning earlier, folks waiting till 70 may have a good opportunity to receive more money and not negatively affect themselves. In this scenario, if we delayed Clark till age 70 to file for Social Security benefits, he stands to gain, or not gain, he stands to receive about $48,000, $49,000 per year. And that substantially improved his cash flow throughout retirement. And just touching on cash flow, we put together all the inflows and outflows, and we want to provide it for each scenario, your current scenario based off now inputs versus a recommendation, just to show you what the difference is. And we project that out through the remainder of your livelihoods. All right. Just going through this quickly, want to show you how that looks for this scenario as well. And then also, we like to put together a bar graph because a lot of folks are visual learners, just to show the annual amount of expenses being paid and the buckets that they're being put to. So vacation home would take up a lot of money if they were to purchase that nearly into retirement. Whereas in the recommended scenario, we could see that they are spending less and less per year on those expenses. Lastly, plan summary. Just wanted to provide you an overall recap at the end of our discussion. And this we would present to Lois and Clark and say, 85% chance if you follow some of these suggestions we made. If not, that's okay. Just have that conversation with us so we can continue to change or edit or be in discussion about what's going on in retirement for you. And we also always want to point out areas that are missing or weren't a part of our conversation, such as an estate strategy or some cash management about having income coming in, or even reaching out to a loved one to ensure that you have protection and care, trusted contact in the event you're unable to be gotten a hold of and financial advisor needs to reach out to someone and make sure you're okay. We want to suggest things of that nature.
So viewers, as you can see, this is pretty comprehensive analysis. It used to be that you would get a goal plan like this, hard copy, and our clients would put it in the drawer, and the subject of the goal plan wouldn't be brought up until we spoke again. Today, all of this information, or majority of it anyway, is available to you online via Playzone. You'll be able to access your goal plan and change some of the variables. If you feel like inflation is not 2.5%, but you feel like it's 10, put in that number and see how it affects the confidence factor of you living, of your money living longer than you. What's the confidence factor that you'll be able to stay retired and finance the goals that you've communicated, right? As you change some of the variables, the confidence factor adjusts right away. This gives us an opportunity to have an objective conversation with you, to tell you what the steps are, to update the plan, and improve your chances of staying retired and achieve the goals that you want. Look forward to seeing you again.
Take care.